Perpetual or the continuous inventory system is the system of inventory management where the information on inventory quantity and availability is updated on a continuous basis as a system of doing business. The system keeps track of inventory balances continuously, and updates are automatic whenever a product is sold or received. All purchases and returns are also immediately recorded in the inventory account. The account for the cost of goods sold is also updated continuously as each slide is made. Basically, before the 1970s, when the digital computers were not commonly used, non-continuous or periodic inventory systems were more prevalent. Prior to computerization, the inventory levels were calculated manually, but we cannot perpetually recalculate every stock position per product stocked by the company. Only parts of the database were calculated for the periodic inventory system, and so the perpetual inventory system was managed manually before computerization. It was one of the first set of tasks to be implemented in the software. In fact, a perpetual inventory system was incorporated into mainframe-based recorder point applications that preceded MRP systems.
There are 5 types of transactions we'll be discussing that deal with the perpetual inventory system. Example given is Johnny is an accountant for a C&J fruit packing company. At the beginning of each fruit season, in May, the company purchases 500,000 boxes at $2 a box on credit. The inbound freight costs $500. Upon inspection, the pack line manager realizes 1,000 of those boxes are inadequate for use and promptly returns them for a refund. The box company gives them a discount of 1% if paid within 10 days. C&J, with such a large order, takes advantage of this and pays on the 10th day. Each day, the company packs up 3,000 boxes of fruit for $5 per box. At the end of the year, there's a shrinkage equal to 1% of the beginning inventory due to boxes getting lost or damaged. The first transaction is going to be the initial recording of the inventory purchased by C&J Fruit Packing. A purchase of 100,000 boxes at $2 a box is equal to $1 million that C&J owes the box company. The recorded transaction is a debit to inventory. The inventory account is under assets. This is because the boxes are resources owned by C&J and have economic value. The economic value is that they are boxes that fruit will be packed into as a service and paid for by a grower for that service at a higher margin, thereby making a profit. The second part of the transaction is to credit accounts payable. Since C&J did not pay cash, they owe the box company the value of the boxes. This is a liability of $1 million for the company. The second transaction deals with the inbound freight. Moving 500,000 boxes will take a large truck to deliver. Assuming the box company charges for that service, it is added to the cost of the boxes. The additional cost will increase accounts payable and will debit the inventory to account, thereby increasing both. This is because the cost is considered a part of the overall asset value. The third transaction is the return of the inventory that was up to par. The transaction here is to just reverse the initial inventory transaction. Since C&J returned 1,000 boxes, each box costs $2. Then that means they will return $2,000 worth of inventory. The transaction is to credit inventory and debit accounts payable, thereby decreasing the amounts in both accounts. The fourth transaction is a discount given to C&J at 1% if they pay their account in full in 10 days. Since the purchase was very large, it adds up to a large sum of money. The initial purchase was $1 million, but the return of 1,000 boxes decreases the total purchase down to $998,000. The discount is calculated based on that number. 1% of $998,000 is $9,980. This lowers the cost of the inventory, and therefore we credit the inventory account by $9,980. This also means that the accounts payable to the box company will also decrease. To do so, we will debit accounts payable.
The fifth transaction is the recording of inventory usage by day. As it will be explained later, it does not necessarily have to be by day. It can be by transaction or any notable period. In this example, Johnny the accountant wants to record how much inventory is used by day. Since the company packs up to 3,000 boxes of fruit a day during the season and charges a grower $5 a box to pack up that box, it amounts to charging the growers $15,000 per day for packing. In accrual accounting, the time in which the revenue is earned must be recognized. This means accounts receivable will be debited $15,000 and revenue will be credited the same. With regard to the inventory, C&J has to account for the 3,000 boxes used that day. To do so, we must take the number of boxes, which is 2,000, and multiply by the original purchase cost of the inventory. In this case, since it costs $2 a box, which equals $6,000, the transactions are to debit cost of goods sold. This increases costs, which decreases the net income. Since the $6,000 worth of inventory is no longer in the inventory, we credit inventory, thereby decreasing it. The last part of the transactions is to record shrinkage. C&J is a fast-paced packing company, and not all the boxes are treated well by the workers. As a result, through the course of packing, some boxes get lost or destroyed. In order to account for this shrinkage in inventory from boxes that are not actually packed up but are lost or destroyed, Johnny must account for that. He estimates that on any given day, 1% of the day's boxes will be destroyed. This amounts to about 30 boxes. That is $60 a day. This transaction will decrease inventory and increase cost of goods sold. It should be, in theory, be in its own account, but as the book states, the shrinkage is so nominal that most companies just include it in the cost of goods sold for reporting purposes.
So in order to evaluate the perpetual inventory system, let's first look at the alternative, the periodic inventory system. So accounting for inventory with the periodic inventory system is much simpler, as it creates less overhead. It's not necessary to keep track of every outgoing transaction. So especially in the case like the mentioned example before, where there can be any number of outgoing transactions every day, it would considerably reduce the amount of recorded transactions when the periodic inventory system is used. So instead of keeping track of every inventory outflow, it's just necessary to document the inflow, that is the purchases during a period, and take an inventory at the end of the period, which means to actually count what's left in stock. So then changes are made to the cost of goods sold and inventory accounts in a summarized way at the end of the period and not all the time. So for that, it's obviously necessary to calculate the cost of goods sold, and that is done by just taking the number of the costs of goods available for sale, lesser ending inventory. So the costs of goods available for sale are just the beginning balance plus some purchases during the period or the purchases during the period, and the transportation in costs, as they are part of the inventory costs, lesser any possible returns. With a simple example, similar to the beginning example, we have 1 million purchases during the period and $500 transportation in costs, no returns, and then this ending inventory of about $50,500. If we apply the example to the formula, then we get an amount of cost of goods available for sale of $1,500,000, and then from that we can derive the cost of goods sold, which are just that amount less the ending inventory of $50,500, which results in a total cost of goods sold of $950,000. So the only thing that's left to be done then is to increase the account of cost of goods sold by $950,000 and reduce the inventory account by the same sum, $950,000.
We will discuss the advantages and disadvantages of the perpetual inventory system. Constant tracking of inventory through technology allows the business to order inventory stock in a more timely manner. It's also beneficial for a business with various locations to use because the data from inventory can be stored in a centralized inventory system. This can help track which stores sell more than others. Being able to track the sales of each store can also help with predicting the amount of stock needed during certain times of year and with setting goals for future sales. The continual tracking also allows for catching discrepancies in inventory from possible theft or waste. Some of the disadvantages include the costly initial equipment. Unlike the periodic inventory system, which can be performed quite cheaply, perpetual inventory requires a certain technology to function. Commonly, a store will need to use barcodes, RFID codes, scanners, and some form of software to track all of this information. Perpetual system still requires a physical count to ensure a most accurate data is input. Use of the periodic system is most useful for new businesses, if you sell few products, or if your budget is small. Any operation that is larger than that will eventually use the perpetual inventory system. In conclusion, the perpetual system is more complex but offers possibilities for analyzing large amounts of data. Continuous tracking of inventory stock helps account for lost, stolen, or returned inventory. Due to the computer revolution in information systems, the perpetual inventory system is more relevant and useful than ever.